Do you want to know what it takes to become a millionaire?
Here are 5 crucial questions that we had to answer in order to become millionaires at 35 and retire at 38. So here are those questions answered.
How can I improve my credit score? Do you know how FICO measures credit scores? 35% of your credit score is payment history, 30% is amount owed, 15% is the length of your credit history, and 10% is new credit. 10% is credit mix like credit cards, mortgages, and auto loans.
When improving your score, you can do these things. Review your credit report, set up payment reminders. Along the same lines, pay your bills on time. If you can afford it, pay more than once in a billing cycle. Limit how often you apply for new accounts. Keep balances low on credit cards. So don't close your oldest credit card. You'll want to keep those around since 15% of your score is based on the length of your credit history.
Ask for a credit limit increase. Now, this doesn't mean you have to use it. So remember that 30% of your score is your credit card utilization. Next is become an authorized user. If a friend or family member has a credit card with a high credit limit or good history or that's been active for a long time, ask them if you could be added. The account holder doesn't have to let you use the card or even give you the account number.
Fix credit report errors. Make sure to use Credit Karma, or you can claim a free report from each bureau once every 12 months at annualcreditreport.com. If you want a more in-depth look at how to increase your credit score, check out our video where we share how we boosted our credit score from the 600s to 825.
What do you use to manage your monthly budget and annual budgets? When we first started tracking our monthly spending and setting a yearly budget, we used a standard Excel spreadsheet. It was really basic, but it definitely helped us define our gaps and understand where we need to start making some changes and where our problems were to begin with. Now we use Mint to start tracking our spending and looking at that on a regular basis, and that's been a total game changer for us. When we started using Mint, we started to use the default categories, and then as we got better and better with it, we started setting up custom categories and also automatically categorizing things that Mint was starting to put in the wrong category.
Yeah.
So there's things that you can do to customize that for yourself.
So why do we love using Mint so much? It's easy to use. They have a very intuitive website and they have a great mobile app. Mint automatically syncs with all of our accounts and categorizes like we mentioned before. If something isn't, you can quickly change it, and you can change it for past and future purchases, which is a rare feature among budgeting apps. It utilizes green, yellow, red status bars for each category in your budget, so you can easily see where you're over or you're under. It gives you the ability to create custom categories based on your family's spending, i.e. like the birthdays, the moving costs, special events, Christmas gifts, etc. And the trends feature on the website allows you to see a variety of different pie and bar charts on your finances, which are great opportunities for just seeing how you're trending and where you're kind of heading. For us, we also, besides Mint, we use Personal Capital to track our overall spending, budgets, and investments.
How much should I have in an emergency fund? If there's one thing that 2020 taught us all, it's that we definitely need to have an emergency fund. Why? Well, it's because you never know what's going to come your way. Even after all that, though, 36% of Americans still don't have enough in their emergency fund to cover $400 for an emergency.
Most financial experts recommend that you have somewhere between 3 months and 6 months of basic living expenses in your emergency fund. The 3-month guideline is more recommended for those people who are in a salaried position with a more secure employment, and the 6-month recommendation is more for those who have a less stable employment or earn a variable income. And remember that an emergency fund is just that. It's for emergencies, not for, this purse, or I need this, I need that. It's for an emergency only.
What do you do about your healthcare and early retirement? And we get this question all the time. It's also a loaded question. It's tough, especially this year for us. Last year we had a great plan through healthcare.gov where we had a super low deductible and low monthly payment. It was better than the plan that we had with my employer that I had for 15 years, much better. Now with this plan, we could only use it at a specific hospital or network. So this worked out really well for us since we were near a great hospital that we've been using for years, and it was highly ranked and well vetted and all that stuff, and we liked the doctors that were there, so that was no problem for us.
After we sold our house in February, our monthly payment was going to skyrocket because the profit that we made from the house was seen as income, so it put us in a higher tax bracket. This is where we decided to actually go with a sharing program, which was best for us during this transition time. So we chose to go with MediShare, and moving back to North Carolina, it meant that the doctors that we had, luckily, were all in network. So that was a bonus for us. So we're looking forward to decreasing our income next year since we won't have the $400,000 profit income from the sale of a house. so that we can actually move back into a bracket and receive similar coverage to what we had before.
There's several options you can look at depending on the amount that you're willing to pay and the coverage that you're looking for. So number one is ask your former employer about insurance. This is something I didn't think about, but according to a 2019 survey, they found that 28% of their companies offering health benefits also offer them to retirees. This is especially true of government agencies, universities, and large companies. Also, check your spouse's insurance and see if that's if they're still working,
right.
Obviously. Browse the marketplace. With this option, you need to be aware of open enrollment periods.
Also, try a health sharing plan like we're on. That's the MediShare. There's definitely different companies that do that. We pay a monthly contribution and the cost of expenses are shared among the members. One thing to be aware of here is that you can be excluded from coverage on certain pre-existing conditions like pregnancy or chronic illness. There's also the option to take advantage of COBRA, and that's if you're still within the 18 months after retiring. And then you also have the option to buy directly from a health insurance agent.
One more thing here is that if you're still planning for early retirement, make sure to invest in preventative health care and open a health savings account while you're still employed. Not only are you saving for future health expenses, but there are also extra tax benefits. How much car can I afford to finance? The golden rule of car buying is that the car's price should not exceed 35% of your gross annual income. It's also better to finance used than to lease new. Better yet, to pay cash. That means if you make $36,000 a year, price shouldn't exceed $12,600. Make $60,000 a year, and the car price should fall below $21,000. And so on. Now, 35% is the upper spending limit. Not everyone should spend over a third of their income on a car.
So which tier do you fall into? Are you the frugal commuter? Are you the compromiser? Or are you the enthusiast? On paper, paying cash makes much more sense. You don't have to worry about a monthly payment. You don't have to pay a dime of interest. It's one and done. However, there's an opportunity cost to paying cash for a car. Say you write CarMax a check for $15,000, and that's now $15,000 that you can invest or multiply. To illustrate, let's say you choose to finance instead of paying cash. You put 20% down or $3,000 and you set up auto pay for a $300 monthly payment. That leaves you with $12,000 today to play with. You could put it in an S&P 500 index fund where it could become $30,000 in 5 years, or you could put it in your retirement account where it could be $113,000 in 30 years. So there's an opportunity cost.
Yeah,
there.
absolutely. Is there such a thing as good debt? In this sense, all debt is the same. We take now and we give back in the future. But because debts can have a positive or negative consequence, they're typically thought of as good debt or bad debt. For us, we feel that it's not necessarily good versus bad, but bad versus worse debt. That bad debt, which some people refer to as good debt, is defined as money owed for things that can help build wealth or increase income over time. These are things like student loans, mortgages, or a business loan. Now, worse debt refers to things like credit cards or consumer debt that do little to improve your financial outcome.
Unless you take on good debt, you may not actually be able to buy a home or anything else like that, which could be investments that enhance your income or your net worth. Managing debt responsibly also helps you build a good credit history. Even that so-called good debt can go bad if you take on more than you can afford. To make debt work for you, be sure to match it to your goals, keep your debt to income ratio under control, and never take on more debt than you can afford.
What is debt consolidation and should we do it? American consumer debt, including mortgages, car loans, credit cards, and student loans, reached $15 trillion in the second quarter of 2021, according to the New York Federal Reserve. Some options for overcoming debt include working with creditors to settle the debt, using home equity line of credits, and getting a credit consolidation loan. Debt consolidation loans are used to pay off multiple debts, and they combine those monthly payments into one.
Although it sounds like an ideal solution, you need to consider both the pros and the cons of debt consolidation. Debt consolidation is the process of combining several debts into one monthly bill on a streamlined payoff plan. When a person consolidates their debt, they get one big loan to cover all those smaller loans, which sounds easier, right? You only have to make one payment instead of several, but that one loan comes with added fees, longer payment periods, and often a higher interest rate.
There are two types of debt consolidation loans, secured and unsecured. If you take out a secured loan to consolidate your debt, you have to put up one of your assets like a car or your house as collateral. If you take out an unsecured loan, you aren't offering up any of your stuff as collateral, which the loan company knows is riskier, so they charge you a higher interest rate to cover their backs.
So now you know what debt consolidation is, you know the types of loans you can get, should you do it? This really depends on your circumstances. Remember, these types of loans come with an extended payoff date. They have fees and often those higher interest rates that we talked about. Sometimes you even have to put up your car for collateral or your home for collateral. When you consolidate your loans, there's no guarantee your interest rate will be lower. All of this to say you might be a good candidate if you have a good credit score, you prefer fixed payments, you want one monthly payment, or you can afford to repay that loan.
Now, there are some downsides to debt consolidation loans. First of all, it won't solve your financial problems on its own. Here's where your budget and your emergency fund comes into play. You can prevent more debt from accumulating if you start laying the groundwork now for better financial behavior. There may be some upfront costs. You may pay a higher rate, and your rate is not guaranteed. Missing payments will set you back even further.
An alternative to debt consolidation is to focus on the debt snowball method that we've mentioned before in previous videos and in previous questions. With this method, you aren't focused on moving around or combining debts, you're working on paying them off. Remember, if you go the route of a debt consolidation loan before signing, review all of your current monthly minimum payments and the expected length of time to repay the debt, and compare that to the time and expense associated with that consolidation loan. But really, the fastest way to get out of debt is to first decide it's time for a life change and then make that happen. To help our channel grow, we ask you guys to do 3 things for us. Make sure to give us a thumbs up, hit the notification bell, and subscribe to our channel.
Also, check out this video where we share our story about becoming millionaires at 35 on a low income with 3 young children. And watch our personal finance playlist so that every penny you earn and save is invested wisely.
Bye. See you
Bye.
later.
Thanks, guys.